Lean into this market or back off and wait for a better entry point? Let's ask Lauren Goodwin, Senior Head of Multi-Asset Strategy for New York Life Investment Management. Gabriela Santos is here as well, Global Market Strategist for J.P. Morgan Asset Management. Both here at Post 9, as you can see. Ladies, welcome. It's good to have you. All right, Lauren, you first. What's really at stake tomorrow, CPI?
Not a lot. Not a lot.
Because the Fed's already going to go?
They're already going to go. I actually expect we might see inflation miss a bit to the downside relative to investor expectations tomorrow. It hinges a lot on shelter prices, which we do expect to come down over the next couple of months. Inflation has clearly peaked. It's likely to move lower over the next several months further from here. But the reality is that core inflation and that super core PCE inflation that Chair Powell pays attention to, that is still too high, and wage growth, which we saw on Friday, still too high. And so from an investment perspective, the trend is known. Hikes coming in July. All
right. Gabriela, do you share the same view? Tomorrow is, I don't know, a nothing burger since the Fed's going to go. Anyway, by the way, most firms on the street think you're going to get headline around, 3%. And you get core around the 5% level. So maybe, give or take off of those numbers maybe causes a more dramatic move if it's more dramatically higher or lower than any of those projections.
Absolutely. And of course, we look at the month over month figure, which are both expected to increase 0.3%. I think nothing burger for July, especially after the labor market report and recent Fed speeches. It really seems like we're good to go. And the market's already pricing in over 90% probability of that. But I do think there's interesting information there. We agree that there's a disinflationary process in place on its own, no need for further hikes. But given the Fed is intent on doing so, I think the important information around the super core is whether we're seeing a normalization in prices, confirming the soft landing narrative recently that's propelled cyclicals higher, or if we miss too far on the downside, we're slowing down too much, hard landing fears resurface, or if it pops higher, we're reaccelerating too much and we're at risk of a policy error. So it needs to be just right and miss just enough.
All right. So what's the everything burger then? Earnings? If this is largely known, right? We think inflation's still coming down. The Fed's going to go in July. They may go another time. Is it all about earnings, which begin later this week?
Earnings are certainly important, but we've already seen that headline revenues, while still positive in nominal terms, about 4.1% in the first quarter. We just got this information, negative in real terms, 1.1%. And the market doesn't care a whole lot. Now, we know that market expectations don't tend to start pricing recession until recession is hitting. But what will tell us recession is hitting may not actually be earnings. It's going to be the job numbers. And so until we see a meaningful deceleration in employment, market may not believe that this hard landing is hitting us, which I still expect is going to be the case later this year.
There is a debate, on Wall Street as to whether, Gabriela, better than feared, which has largely been the case for the last few quarters, is good enough now. It was fine then, but it might not be good enough now. What's your view on that?
So I do think, to your question, the everything burger really is earnings, just given that the whole return this year really has been driven by multiple expansion, up 17%. So earnings have got to start coming through. The trick with this earnings season is that expectations have not come down, as they often do, going into an earnings season, nowhere nearly as much as normal. So I do think beating those expectations is not enough because the expectations are not that low anymore. And for the earnings season, beyond just the macro read-through, for example, from financials coming up on the state of the consumer, I think really the focus is on margins, right? For both the stock market investors and bond market investors, are companies able to maintain enough pricing power, but not too much, where inflation then becomes a problem again, and we're back to talking about policy error and hard landing. So really, both CPI and earnings, it's really about finding a sweet spot here.